film at the entertainment giant. Shares sharply higher on the news. Up right now.
Well, I love to say I told you so, but Disney has been one of the top performing stocks that I picked in January, and I picked it at 86.88. It is now after hours almost at 121. That's up 39%, folks. Not bad.
A major restructuring, which he described as a transformation that rationalizes the streaming business and puts the company on a path to sustained growth and profitability. Now, the new Disney structure has three segments. The first is Disney Entertainment, including TV, film, streaming, that'll be co-run by Alan Bergman and Dana Walden, who previously ran film and TV. There's a new ESPN division run by longtime ESPN chief Jimmy Pitaro, and a Parks, Experiences and Products division, which continues to be run by Josh D'Amaro. Now, Iger saying that this structure aims to return greater authority to creative leadership. Iger also announcing that the company is targeting $5.5 billion in cost savings. $2.5 billion of that is non-content costs, and then $3 billion will come from reducing non-sports content costs, also announcing the plan to cut 7,000 jobs. Iger also reiterating the company's target of Disney Plus hitting profitability by the end of fiscal 2024. Also, they just said that they aim to reinstate Disney's dividend by the end of the fiscal year. CFO Christine McCarthy just moments ago saying that the Disney Plus price increase is playing out as expected with only modestly higher churn. She also said that they're going to stop giving subscriber guidance, but she did say more generally that the core Disney Plus subscribers, and those are the most valuable ones, they grow only modestly in the fiscal second quarter, at a similar pace to the first quarter, with higher core subscriber growth towards the end of the year. And just some positive commentary here about how the ad tier is off to a strong start. Make sure to tune in to Squawk on the Street tomorrow at 9 a.m. Eastern. Bob Iger, Disney CEO, will be joining David Faber in a CNBC exclusive interview. Melissa?
Julie, I'm curious in terms of the restructuring, your reaction to walling off ESPN, because that seems like an obvious move toward potential spinning it off or potentially allowing that business to get deeper into sports gambling.
I mean, look, I think that it does exactly that. What's so interesting here about the ESPN business is that at one point it did really make sense to combine it with the linear TV business. But now sports is such a separate thing. The rest of the entertainment business, whether it's TV or movies, and this question of whether things should be put on streaming or released in a more linear, traditional manner, that's a very different story than the decisions and conversations that are going on at ESPN, and also the conversations about how to invest in sports rights and what to prioritize right now. So I do think it is very, very rational, and it does, of course, set up ESPN to be a separate piece that someday, should they want to separate it out, they would be better equipped to do so right now.
I had the exact same thought that you did as soon as I saw that, which I think they wanted that, people to have that thought. I mean, to me, it seems like this call was basically a shareholder sort of presentation for the proxy fight. And, you know, look, we're doing all these things, we're moving forward, and we've made, you know, momentum here, and we're cutting costs there, and don't vote for Nelson Peltz.
Right.
That's what it seemed to me.
Yeah, definitely. Julie, we'll talk to you a little bit later on. Julie Borson, who will jump on the conference call. What was your reaction to all of this? I mean, you know, when a CEO comes back, when a new CEO comes in effectively, right? You know, you set the agenda on that first conference call.
Well, I think everyone was so happy to have Bob Iger back. He's almost the adult in the room, if you will. And with him there, to Karen's point, you don't need Nelson Peltz. If he was not there, then you need Nelson Peltz in the room. For me, I've been along this name, I thought it would bounce to 120, 130. If I look at the pandemic, the low was $85 during the pandemic. The high before that, the February high, 140. I don't know what's the right price, but I know it wasn't 85. I think it gets back to $130. I can make the case that it shouldn't get back to pre-pandemic levels, but I know that the parks are going to be opening up. The parks are going to surprise to the upside. That's why I held the stock.
Yeah, Julie?
Yeah, I mean, I think it's interesting when you talk about, you know, his being the adult in the room, but if you really look back on the M&A, and this has been Nelson Peltz's deck, which I think is a really good resource, they've spent approximately their market capitalization on new acquisitions that really haven't panned out. They've been very expensive, and all you've seen is an earnings contraction. So I worry that more of the same isn't really going to get the results that you want. And I think it makes sense to just, if you want an activist to go away, let them on your board. It typically has a really good impact, and they stop talking because they can't.
Guy?
Good point.
Remember barbarians at the gate? I mean, they're barbarians at this gate, and I think this quarter is trying to keep them outside of the gate. And listen, cost cutting, I think for a couple quarters, people will be thrilled with, and you have to ask yourself, is this a long-term approach to continue to get the stock to where it needs to be? Steve mentioned a level. I think it was March 20th, if I'm not mistaken, during the pandemic, the stock traded down to 85. We collectively talked about that back in November, that this is a level it needs to hold, should bounce from here. It's done that. So 122, if you look at it, that was a high back in August. I think that's where we're trading now, so it makes sense we stall here. But again, Disney Plus being profitable, I will tell you, if Tim were here, he'd mention ARPU, average revenue per user, is actually trending the wrong way. It came in at 393. She was looking at 425. So I think, to be honest with you, I mean, this is the quarter that if you've enjoyed being long the stock since the fall, I think you got to be taking some money off the table and look for a back and fill.
You also mentioned, Karen, ARPU.
I thought that was a character. Disney, right? ARPU, cute, fuzzy.
It might be.
Yeah. Right. No, it's just a metric that sort of jumped out. I think that it's interesting, though. I just want to go back for 1 second. Had they done this ESPN spin, or spin is not the right word.
Right.
Separation.
Prelude to a
prelude.
spin.
Right. Prelude to a spin. That's a movie, I think, right there. But I think it would have traded even better in a slightly different era. I mean, media companies have been under tremendous pressure. I still think it's the right thing to do. So, I mean, clearly, streaming is Iger's baby, right? This is his brainchild. He has got to make it work.
Right.
And now he's saying it's profitability over sub-growth. So that's a different angle than when we're all looking at this. It was what was sub-growth. So he leaves himself...
Well, now they don't even want to do sub. They don't even want to talk about it.
So it leaves himself room to fail now and still win in the game, because that's what he's looking for. I'm looking for more efficiencies versus the overall number.
I feel like emphasizing profitability over sub-growth, I mean, that's good, obviously, from the shareholder standpoint, but at the same time, Guy, streaming and gaining share in streaming has always been growth at all costs, and it's always been content spend. And all of a sudden, every streamer out there it needs to rationalize, and Disney needs to do that too because of the profitability aspect and the demand from shareholders at this point. So is that the right environment to say, you know what, Bob Iger is going to be able to make this work when his hands are tied a little bit? In another environment, all that would have been fine, but not in this environment.
Yeah. Especially when the environment seems to be going back the wrong direction. And I will tell you, I mean, a lot of the initiatives being put forth are some of the things that Tom Rogers has talked about for a while. I think there's an understanding that, all right, sub-growth, we probably maxed out on this front, so let's stop talking about it and let's focus on profitability, which, by the way, is fine. I mean, you get to a point, but I also think they realize that they can out-Netflix, and it's their world that everybody else is living in. I've thought for a long time that Disney Plus was a bit of a loss leader. It's proving to be exactly that, but it plays into the flywheel strategy. The question is, you wrap all this stuff up, talk about ESPN. He being Bob Iger, fighting this seemingly double-sided war, one against DeSantis, the other one seemingly against Nelson Peltz. And do you want to pay 23 times next year's numbers for this stock? It's had a great run. Again, we had talked about it in the fall being cheap. I don't think it's cheap anymore.
All right, for more on Disney's earnings, we are joined by New York Times columnist James Stewart. He's also CNBC contributor, the co-author of the upcoming book, Unscripted, the epic battle for media empire and the Redstone family legacy. Here. That's going to be a juicy one. Jim, great to have you with us. What's your take on Bob Iger's big plan?
Well, my take is he really has his work cut out for him. I mean, he gave a great presentation. This is Iger, the master of shareholder communication. He is terrific at that. I give him all the credit for that. But let's step back here for a second. You look at the last quarter, there's a lot of ammunition for Nelson Peltz in there. You have flat subscriber or no subscriber growth. You have still $1 million loss in the Disney Plus. You have a sort of alarming decline in cash flow. Now, in fairness to Iger, he hasn't been there long enough to really do much about the spending. But there's a serious conundrum here. how do you cut this spending without losing subscribers? And I still think, analysts, everybody in the street, investors believe streaming is ultimately a scale game. You have to be big. You have to spread those costs over a very large number of subscribers. And if you start cutting spending too much, I don't care how much you realign the creative teams, you can't just produce hits, and you're going to have trouble with those subscriber numbers.
James, when you look at the option for third-party licensing, who would the third party be? Everyone's a competitor. So if that's going to be where he's going to turn a revenue or turn a profit or increase something on the bottom line, who are these third-party people that he's going to be licensing?
Yeah, I have no idea. I mean, again, who are the big licensors? Well, Netflix is number one. That's off the table. I think it's baffling. I think the idea that you're going to turn a profit in 2 years is a great aspiration, but is that really realistic given the numbers we're seeing? I don't know. And you're going to squeeze $5 billion out of there? That's a huge challenge. Cost cutting has never been a long-term growth strategy for anybody in my experience.
James, I'm curious how you're thinking about overall profitability. Netflix running EBITDA margins between 15 and 20%. How on earth can they get there? Even if they get there kind of revenue-wise, it doesn't seem like the profitability will be anywhere near that.
I don't see it there. I mean, look, a lot of the success of Disney's numbers this quarter came from the theme parks. And, again, they're doing a great job there. There's been tremendous pent-up demand. But that pent-up demand, the ability to keep raising prices, streaming the lines and making people pay more, there's an upper limit to that. China reopening may help the Chinese parks, but you're not going to have 25% growth at the theme parks for the foreseeable future. So if you start taking growth out of the theme parks, where else do you see it? The linear networks are in decline. Everybody knows that. I mean, maybe the advertising market is coming back, or people think there's going to be a soft landing. I think that accounts for a lot of the run-up. But even that is not a sure thing. But let's give them that. Let's say the advertising does come back. I don't see them getting anywhere near the Netflix numbers.
So, Jim, do you think that these problems are too big for Iger to tackle? Is it that Iger doesn't have the talent, or is the macro, the environment it's just too challenging for anybody to try and tackle these issues?
Well, I think it's mostly the macro environment. It's the competitive environment, the competitive landscape. Bigger is going to be better in this business, as far as I know. And Disney is hobbled by a balance sheet that has an awful lot of debt. You're not talking about him. The days of Iger being the master M&A acquirer, nobody's talking about that except Nelson Peltz. You don't see, Disney's not going to buy a big competitor, even if they could get away with it in a regulatory standpoint. So again, if this is ultimately a scale business, where is Disney going to get the scale? And I don't think that's an Iger problem, but Iger is very invested, and personally, his legacy rests on streaming. And I'm sure he is going to work really hard. I mean, I think one of the things I both sort of admire him for it, I think, what was he thinking when he came back? He had the best reputation in decades of anyone in business, the media landscape. It was sterling. How can it get any better? His legacy was fantastic, and now he's back trying to defend an assault on his legacy streaming service that's coming from all sides.
Jim, all great points. Thank you. It's always great to get your take. Jim Stewart of the New York Times. We sort of made that point initially when he came back, Guy, and it was sort of the flip side of it, that Iger must feel really good about conquering these issues if he were to come back, since he already had such a great legacy when he left. Why would he come back? And here we are, it's sort of the flip side of it. It's like, well, why did you come back? You're going to tarnish your reputation at this point.
Listen, we all have egos, and at a certain point you say, you know what, they've run this into ground. If I come back, I can fix it. I can bring it back to the levels that it were at its zenith, because everybody believes in themselves. That's why successful people are successful, because to a certain extent they will certain things. But now you're starting to see some of the headwinds that Jim just talked about. By the way, the same headwinds that Tom Rogers talked about as well, and that we've brought up. This is a tough nut to crack in terms of the streaming business and in terms of getting to profitability. I don't see how it gets there. And oh, by the way, it's not a cheap stock now either. So you have a couple of those headwinds. And, you know, again, talking about ego, I mean, I can't speak for Mr. Iger, but I guarantee he does not want Nelson Peltz anywhere near a board seat. That's just my opinion.
Yeah, Disney shares up 5.2%, well off the after-hour session highs of up about 9%. We'll continue monitoring that call. Meantime, shares of Google parent Alphabet dropping more than 7.5% today. Their worst day since October. The company holding an event to show off its ChatGPT competitor, Bard AI. This is a day after Microsoft unveiled its own artificial intelligence bot integration. But things didn't go as smoothly as hoped. In an ad promoting the event on Twitter, Bard appeared to give an inaccurate answer about the James Webb Space Telescope, raising concerns over the software's potential. Shares about.
And I didn't realize they were going to even do a report that long about it. But yes, Disney stock ever since I mentioned it, 86.88 back in the first week of January. Now at after hours is 117.60, and so at roughly 35. So anywhere from 35 to 39%, depending upon what the price is. It did, when I first came on here, it was at 121. I had recommended buying it. I honestly thought we could see 140. We've already, I think, if I remember correctly, at the end of the year, we've already basically hit our end of the year target already. So we did cut back some shares. 86.88, and we actually sold some at 110. We still own some, but we did cut the position in half, looking to add more, only because, to be honest, we had a nice move. We sold at a 30%. We like, personally, Disney. We like Disney stock. But would we be buying here at 117, 120? No. We would definitely be waiting for some sort of market pullback, and we might wind up trading it at times and stuff. But we still think it's a good stock over the next 2 or 3 years to get to 140, but it's happening quicker than we would like. So, but I wanted to follow up on that. I am going to do a video on the separate stocks that I mentioned: Disney, Rent-A-Center, PayPal, Vulcan, and American Waterworks. And somebody requested I give an update on Southwest Energy, so I'm going to do that. So, guys, thank you. I do appreciate you watching. Sorry that was a little long in the beginning with the CNBC. I watched it live with you guys. There's not much more that I can add to it as far as, obviously, I gave you my reasons why we like the stock, and we did good. So sometimes you get lucky. So full disclosure, I am not a licensed broker. I do this, I guess, entertainment, but I never recommend anybody go out to buy stock. I share my experience with you and why I think it's a good case or a bad case to short or go long stocks. This is the first video I've actually made probably in 3 weeks. I'd like to do more. I've been busy with stuff, and I don't try to force videos. But if you guys could do me a favor, like and subscribe, I'd greatly appreciate it. I'd really like to monetize this channel this year, but need 1,000 subscribers, and I'm about halfway there. So support me, money me, and I'll talk to you again.